Some of the banks are looking at, triple digit silver, some by the end of this year, which could be, I don't know yet. When you're getting your neighbors talking gold and silver, or somebody that, hated that sector and all of a sudden is really enthused about it, that's a top. And we didn't see that. What we saw was a lot of retail that was stale, had held it for years, never thought we'd get above 50 again. It hit 50, and there were a lot of sales at 50. People were, that's it. It's never going higher. Every time it goes to 50, the banks clobber it down.
The last couple of times that happened, gold and silver went down along with equities. So we could see the same thing happen again in the short run. Or we could well see while this is happening, the realization that the fiat currencies of the world are not long for this world in any event. So we should be shifting into real money, and the turmoil of this next break in the market could send people into precious metals.
Mainstream institutional analysts, including those from JP Morgan and UBS, maintain a base case scenario where silver prices settle between $81 and $100 per ounce by late 2026. These forecasts are predicated on a gradual easing of Federal Reserve interest rates and steady industrial consumption. According to reports from early 2026, these levels represent a normalization of the silver price as it catches up with historical inflation-adjusted peaks. Well-known experts David Morgan and John Rubino declares that reaching $100 silver was a major milestone. He mentions that many long-term investors, some holding silver for years or even decades, finally saw significant gains and began cashing out to fulfill personal goals. He predicts that silver could move into triple digits again, possibly even higher, but explains that the market has not yet reached a true peak. According to him, major market tops usually occur when everyday retail investors become overly excited and convinced prices can only go up. Moving forward, David Morgan emphasizes markets are facing extreme uncertainty, especially due to tensions involving Iran and the ongoing Russia-Ukraine war. He explains that oil is the key concern since energy affects all sectors, yet he believes it is still underpriced given the risks. Despite this uncertainty, gold and silver have not surged but are moving sideways after a strong rally earlier in 2026. He predicts the bull market isn't over, with prices likely staying in a range for some time before the next major move. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from David Morgan and John Rubino's recent interview.
Well, I would say maximum uncertainty. Markets really dislike uncertainty. And, this thing with what's going on with Iran and, of course, the Russia-Ukraine situation is, kind of in a distant background, but it still continues. So the main problem with the Iran situation is oil, and oil means energy, and energy means life. And so with the decrease in energy, it cuts everywhere. It cuts into fertilizer for food production. It cuts into transportation, anything to do with, travel, etc. So it's huge. It's really, really big. And I don't think the oil market has really gotten to a level that is accounting for the disruption that's already taken place, let alone what could be in the future. So in my view, oil is still undervalued or underpriced. And the metals have reacted differently than most people expect. They expect with this kind of uncertainty in the market that the metals would go up, and they haven't. They've stagnated and really are in a pretty broad trading range, all metals, gold, silver, platinum, and palladium. And I called that. I made that call. I thought that, these markets often do what they don't expect, and they anticipate the future. So we got a huge run-up in silver in January 2026. I put out information for my members to, look at taking profits, in the above 80, actually, 80 and into the 100 range. Some did. I'm not sure that's the total top, but Bloomberg did an article from one of their technical analysts, well respected, and he basically put out a paper saying that he thought silver was perhaps done, that the run it had in January 2026 was over, He made an analogy to the 2016 move and other parabolic moves where it got to that high, it fell off sharply, and then it went sideways for a very long time, like years. And he made that argument. I'm not, first of all, the analogy he made is valid. Secondly, does that mean that it's going to happen again? And the answer is we do not know. I suspect the metals bull market is not over. I do see higher prices in both the metals going forward. But unlike some of my peer group, I think it's going to take longer than many of them are indicating. And even some of the banks are indicating, $100 silver by the end of this year. Is that possible? Of course it is. From my perspective, sitting here right now, subject to change, something could happen and disrupt, silver supply, or maybe a big new technology needing silver or whatever. But barring that, I see further movement going in a trading range, and I don't really think we're going to come out of that until probably the end of this summer. And at that point, we could still be between 75 and 85, for example, which is a good price. I mean, if your average price is in the 20s and it's at 80, you got 400%. So I'm not complaining about that price. What I'm suggesting is that we're in a wear you out phase, I think, of both the metals right now. I just had the $100 silver party in Las Vegas. I'd promised my membership that if we hit $100 silver, I would throw a party, and I did. And it was interesting because I had to put all the logistics together before silver got to 100. So I had to anticipate that it would. And if it didn't, and it hit, let's say, 85 as an example, I was just going to have the party anyway, because there's a lot of moving parts to put together something like that. Anyway, it did. It went over 100, as you know. But I'm coming back to your question, and one of the guys bought a boat, and I'm not talking like a fishing boat. I'm talking a boat.
Wow.
And he showed me a picture of it, and that's what he did. And that was, one of his dreams, or maybe the big dream for him. And I was just very happy for him, because obviously a lot of silver investors that have, are long in the tooth. I mean, some bought, for the last 20 years, some bought in the last year. But many are 5 or 10 years into this market, patiently waiting for silver to make a move, and it finally did. Substantial move. And why not cash out? I mean, that's the reason, everybody's got a different reason, for, one's wealth protection. That's generally everybody. But, people have dreams of houses, boats, college educations, charity, whatever. So there's a lot of reasons to protect your wealth and then have options once you have your, wealth intact, what to do. Yeah, well, again, some of the banks are looking at, triple-digit silver, some by the end of this year, which could be. I don't know yet. I think the reason that I feel that it will go higher still is this. Normally in a huge bull market, be it stocks or real estate, whatever the market is, the retail investor, the average person on the street, is talking up that market. So, real estate investors, maybe, for example, my mother-in-law, we've had a couple, 2 or 3 really good real estate booms in my lifetime. There was one here in northern Idaho, and, it was lots of people, primarily from California, but other states moving into the area, and they're just bidding up prices higher and higher and higher. And she was convinced, you can't lose, just like the lady buying the silver you just talked about, and brought me over to see a condominium. And this thing was just so overpriced. I couldn't believe it, but she was convinced that, all you could do is make money. That to me was kind of the top of the board. So, man, it was. And I'm making a point, not that I call every top perfectly. The point I'm making is that the shoe shine boy giving stock tips, which is well-known metaphor from the 1929 crash, whether that's true or not, it makes a great story and it illustrates it perfectly. When you're getting your neighbors talking gold and silver, or somebody that, hated that sector and all of a sudden is really enthused about it, that's a top. And we didn't see that. What we saw was a lot of retail that was stale, had held it for years, never thought we'd get above 50 again. It hit 50, and there were a lot of sales at 50. People were, that's it, it's never going higher. Every time it goes to 50, the banks clobber it down. I'm not going to get the analogy of, Lucy taking a football away from Charlie Brown when he goes to kick the football, or Linus, whoever it is. She's holding the football to punt or kick, and then as soon as he gets there, she pulls the football up. They weren't going to let that happen again. So a lot of sales, and then a lot of sales into the move up to 100. So I think, as I've said earlier, we're going to have to wait and see how this really flushes out. But I don't think it's over. I think that we've got to see those people, your neighbors, people that never talk gold and silver, coming to the fore and saying, silver is indispensable, essential, irreplaceable, unobtainium, and the price is going to $1,000. We start hearing that again, probably in a place where you want to start looking at, taking some profits.
During the interview, John Rubino notes that the mining sector is entering one of its strongest earnings periods as higher gold and silver prices are generating significant free cash flow for companies. Major miners like Newmont Corporation are using this cash to reward shareholders through dividends and buybacks. But he predicts that over time, they may start acquiring smaller mining companies to boost growth, which could benefit investors holding junior miners. Despite strong earnings, investors should remain cautious and focus on companies improving their financial health. Beyond markets, Rubino further predicts a potential deflationary downturn followed by aggressive money printing by central banks, which could ultimately favor gold and silver. Meanwhile, he notes that asset-backed digital tokens, especially those linked to gold and silver, could increase demand for physical metals in the future. Even with recent dips, analysts note continued investor interest and bargain buying, while long-term drivers like inflation, oil prices, and uncertainty continue to support precious metals. Let's get back to the interview.
Well, this is going to be the best earnings season in the history of the mining industry, at least in terms of gold and silver, because the price of those things have been rising. And, they were not rising, but still pretty high during the first quarter of the year. And that means that these gold and silver miners are getting more for each ounce that they sell. And they're generating a lot of free cash flow. Newmont, the biggest gold miner and one of the biggest silver miners, just reported yesterday, and they had free cash flow of $3 billion, which in the mining business is a lot of money to play with, and what they're doing right now is they're buying back their stock and they're raising their dividend, which is a really nice thing for them to do for shareholders. And at some point in the future, though, when you're generating that kind of free cash flow, it eventually burns a hole in your pocket if you're the CEO of a mining company and you start going out and making big acquisitions. In Newmont's case, their production is stagnant, and that's a tough thing to justify when you go before your shareholders. Why aren't you growing? You've got all this money. So at some point, they're going to start buying up the smaller miners. And if you own those smaller mining stocks, that's a good thing. That's generally a good thing because they'll have to pay a premium to get your stock away from you. Now, the same thing is happening across the gold and silver mining space, where everybody's reporting relatively good numbers, whether they're a senior miner or a junior who's just getting started with a single mine or whatever. The numbers are looking pretty good for everybody. And that's not necessarily a buy signal, because what you also have to look at is the trend in gold and silver prices. If gold and silver are going down, then it doesn't help you that a miner's earnings are going up in the short run, because people assume that their earnings will go back down later on. It does give you some entry points for some of these miners, because, if you've got all of a sudden a whole bunch more cash than you did a year ago, which a lot of these guys do, then you can use that cash to improve your company in various ways. You can cut debt. You can go debt-free. In a lot of cases, these guys can. You can raise the dividend. You can buy back stock, and that improves your company as an investment. And so if you're a potential investor, you should be looking at the companies that are doing things like that. Like if somebody, a junior miner, just went debt-free because they had so much free cash flow that they were able to do that, then all of a sudden they're a much more attractive company than they were when they had massive debt. So if you're building a portfolio of mining stocks, this is a good time to kind of root around in there and see who is, first of all, generating a lot of free cash flow, and second of all, using that cash to improve themselves. So if the stock's not going up while the company is improving its finances, for instance, dramatically, then that's maybe a buy signal. It's a good entry point because eventually people will recognize that this is a better company than it was last time they looked, and they'll start buying the stock and it'll go up. On a deflationary phase, the first part of this, let's say AI starts laying off a lot of people and the economy starts to tank, you don't want to be massively long the stock market when something like that hits. So if you've got some profits in stocks, this might not be a bad time to take some of those profits and then either just keep them in cash, keep your powder dry, wait for things to drop and then look for bargains, or maybe even short the market a little bit. This is what's happening today is similar in a lot of ways to the housing bubble of the 2000s. And if you saw the movie The Big Short, the people that were profiled in that movie basically saw a crash coming. It was for a different reason than for today. They saw that coming, and they basically shorted the sector of the market where that crash was located. And they were too early. It went badly at first for them, but they ended up making life-changing money. So, if you're a little bit financially sophisticated, if you know how to actually short the NASDAQ or whatever, this might not be a bad time to be looking into something like that too. Not with all your money, but with, 5% or maybe 10% of your nest egg. That buys you insurance, basically, against the rest of your stock portfolio crashing. And then, gold and silver, we'll have to see what happens if we have a sharp deflationary break in the economy. The last couple times that happened, gold and silver went down along with equities. So we could see the same thing happen again in the short run. Or we could well see while this is happening, the realization that the fiat currencies of the world are not long for this world in any event. So should be shifting into real money, and the turmoil of this next break in the market could send people into precious metals. And I'm not sure which of those scenarios I think is more likely. But I think with precious metals, it probably makes sense just to dollar cost average into more gold and silver over time and not think about squiggles in the market, because what follows the deflationary crash is a massive increase in the money supply. The governments of the world will have to inflate their way out of what they perceive to be a potential depression, and they'll do that with negative interest rates and massive quantitative easing and possibly equity buying, which they didn't do so much last time, but they might do this time in a big way. And if you own gold and silver, when that happens, you're going to do great, because when they're inflating away the currencies of the world, precious metals will just take off. And I think that a few market shorts, a little bit more gold and silver, and we're probably okay to get through this. We know maybe it's just the people that I hang out with, but it feels like there's a sense out there that central bank digital currencies are not really financial instruments. They're means of control. And in the sense that they set you up with a FedNow account or whatever. And once you've funded that account and you're doing things with it, they see everything that you buy everywhere you go. And they basically have full spectrum surveillance on you, thanks to this new currency. And a lot of people seem to get that. And because of that, they're against central bank digital currencies. And I think that's reflected in Trump's policy here. His people seem to be opposed to that next transition in the financial market. And, here's hoping that we delay it long enough to kill it. And we'll just have to see. Now, the stable coins, that's kind of a separate thing. That's part of the crypto universe, where, say, you put a bunch of treasury bonds or gold bars in a vault, or a financial vault in the case of treasury bonds, and you issue tokens against those assets, and those tokens trade on a blockchain like a cryptocurrency, and it's a way to make your financial accounts more or less frictiony. You can just trade instantly doing something like that, and a lot of people find that appealing. And that's also good for gold and silver. If they start tokenizing precious metals, then that means they have to buy a lot of those things. So that's, we'll have to see how it goes, because there are a lot of aspects to these things. But the fact that Tether, for instance, has a gold stablecoin, and it seems to be popular, is a potentially good thing for precious metals, because, if you do gold and it works, obviously you're going to do silver too. And Tether now is a holder of gold on a small central bank level. That company is a major gold buyer right now. And that's just them. There could be a lot of other companies coming into this space pretty soon. So that's potentially a great thing for gold and a spectacular thing for silver. So we'll have to see how that goes too. But there are a lot of different aspects to the transition that we're going into now financially.
Despite short-term consolidation, the combination of rising demand, potential monetary easing, and future liquidity injections points toward a longer-term bullish outlook for gold and silver. Emerging trends such as asset-backed digital tokens may further strengthen demand for physical metals, adding another layer to this evolving financial landscape. Mainstream institutional analysts, including those from JP Morgan and UBS, maintain a base case scenario where silver prices settle at $100 per ounce by late 2026. This forecast are predicated on a gradual easing of Federal Reserve interest rates and steady industrial consumption. According to reports from early 2026, these levels represent a normalization of the silver price as it catches up with historical inflation-adjusted peaks. Driven by a 5-year global supply deficit, rising demand in technology, and safe haven investment appeal, some projections even suggest potential for higher prices, though not without volatility. As silver moves toward higher normalized levels while global uncertainty and monetary risks continue to build, will the next major rally be driven by fundamentals or by a sudden shift in public sentiment and financial panic? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.